Good day, welcome to lesson 4 of investment securities. This is grade 12 work term 2, and we're continuing with the types of investment, but we're going to focus today just on the impact of 4 different investment types. Okay, so after today's lesson, which is quite a short one, you should be able to explain or discuss or analyze or evaluate. That means give the positives, the advantages, and or the negatives or disadvantages of the following forms of investment. We're only going to look at government or RSA retail saving bonds, unit trusts, shares, and fixed capital. Now, I'm not going to go through definitions again. It's exactly the same as the previous videos, so you can double check that or revise that there. Okay, so as we said, this is what we're going to discuss today. Now, important, when you see the word impact in a question, you need to give an answer that will elaborate on the positive and or the negatives of the specific topic in question. For example, when we look at what the impact of Ironman event was in Port Elizabeth, then we'll see that there's an economic injection, businesses grow, there's a lot of tourists that spends their money here, so there's more people, so there's a lot of positives. The negatives can be there's bigger opportunities for crime, fraud, etc. So I want you to look at it or answer the questions from that perspective. So let's start. On our previous video, we summarized RSA retail saving bond as it's an opportunity to invest in saving bonds, and you can revisit that lesson in the previous video. So when we today look at the impact of the retail bonds, we want to look at the advantages and what's the disadvantages. So when we look at what is the advantage of a retail bond, or the advantage that you'll have of investing in a retail bond, there's the following advantages. So there's a guaranteed return. This means the interest rate is fixed for a whole investment period, which makes it that your return is guaranteed. There's no fluctuations. The second one is the interest rates are market related, and thus more investors are attracted. So it's not a specific or a special interest rate, it's market related interest rates. So it's not a lower interest rate, but it's a market related one. Okay. Next point is interest will be received twice a year or every 6 months, so that's the advantage. It's not a once a year payout, it's every 6 months, so that's twice a year. Your interest is normally higher than your fixed deposit, so as I said it there, your return on your investment is better than your fixed deposit due to the interest rate that is higher. Your retail bonds, they are listed on the capital bond market or on the JSE, so it's listed, it's advantage. It's a relative low risk, it's a safe investment, as it is as you invest your money with the South African government, and they cannot be liquidated. There's no charges, there's no costs, there's no commissions payable on this type of investment. So therefore your return is much higher. Another one is there's easy access. So your investment is easy accessible, and you can withdraw your cash after the first 12 months. So this is also a fixed term with the option of withdrawing your funds, but that's one point that's in the negative side. Should you withdraw your funds within the first 12 months, you'll be charged a penalty. Okay, if we look at the other disadvantages, you cannot use that as a security to obtain a loan from a bank. You have to invest a minimum of R1,000 in this retail bond, and that's sometimes difficult for small investors to gather that amount of money. Retail bonds are not freely transferable amongst investors. So if you if it's your retail bond, it's not freely transferable. Some requirements: you need to be have a valid SA identification, so you must be a citizen of South Africa and you should be older than 18 years. And that will probably discourage younger people to invest, as well as foreigners that they will not invest. Okay, so we've discussed the penalties as well. So this is what you're looking at when you see the impact. So how will it impact you, the positives versus the negatives. Okay, on the next slide. One that I almost forgot is you can freely buy this this retail bond. You can buy that at any post office, so it's easily accessible. You can obtain it conveniently or electronically from any post office or directly from the National Treasury. Alright, so next one is unit trusts. So in the previous period we looked at unit trust. You remember that basket of X, so it's about you buy a basket full of shares, different risk levels, and with a relative good amount of return, with this risk spread out through your basket. So your advantages is it is managed by a fund manager. Okay, so he will buy your shares on the stock exchange, on the JSE. He's an expert, and you know that you can rely on them. They're trustworthy, and they are required required to be accredited to sell unit trusts. Okay, so that's a risk reducing element. Next one, I said the liquidity factor. That means it's easy to cash in when an investor needs money. So when you need your money, it's easy to cash in your shares. You can sell it and you'll have your cash in hand quickly. Okay, if you need to invest in small amounts, you can do this. You can invest small monthly payments in a month or investments in a month. So that can be a debit order that you invest in, so that you can increase your investment or your unit trust portfolio. Now your return, it generally beats inflation on the medium or long term. So if you leave your shares untouched for a medium or long term, your returns will be generally higher than the inflation rate. Okay. It's normally a safe investment because it's managed according to specific rules and regulations. The investor has a variety to choose from, a different set of shares or different company shares, and that ranges from lower to higher degrees of risk. So that's your choice, and the fluctuations in the unit trust rates are often not so severe because of the diversity. So even if there's fluctuations, not all of your shares will be affected. If we look at the negatives, share prices may fluctuate. Your unit trusts are not allowed to borrow, and therefore your potential returns could be reduced. So your return will be might be less if your return on investment will most likely be less due to the fact that the unit trusts are not allowed to borrow. Okay. Next one is it's not good for people who want to invest in a short term. If you want to buy shares, it's a long term period, so it's not a good option. It's also not a good option for people who want to avoid risks at all costs, and because this has got a level of risk that goes with it. Then another point is the outcome is dependent on external factors. What I mean with that is if blue chip companies, if their growth or if their company is not performing well, then the unit trusts growth will also be affected, and therefore your returns will be affected. Okay, last one that we're gonna do, we're gonna do shares now. Shares, in the previous period we went through what is a share, what the voting rights are. It must be on listed companies, on the JSE, stockbrokers. So let's look at the advantages and disadvantages. Okay, shares can be freely transferred or traded on the JSE, so there's no restrictions there. Shareholders' liability to the debt of the company is limited to what he has invested. So you as a shareholder are only liable for what you've invested. Okay, so if a company is liquidated, you're only liable for a portion of which you invested in. You will not lose the whole company's worth of money. That's not yours. You only lose the amount that you've invested, or according to your amount that you have invested. Okay. Next one, there is some voting rights that some shareholders have, and that you'll use at the annual general meeting. If you want to invest in shares, that will provide you with protection against inflation. If you invest in shares, it will provide a solid return at retirement age. Your return on investment is linked to the performance of the company. I've said that in another point as well. And your ordinary shares are usually cheaper than preference shares. And the last one is the number of shares linked to dividend payout. That means if you have more shares, or depending on the quantity of shares that you have, that might result in a higher proportional dividend payout. So the more shares you have, the more is your proportional dividend payouts. Okay, disadvantages of shares. There's a low return that goes with it. Excuse me. You may receive less dividends or no dividends when the company profits are low. So that's where the low return comes in. There's companies that have no legal obligation to pay dividends to shareholders. So let's say there's the company suffering due to, for example, COVID-19, and there's no profit, and they're not obliged to pay out any dividends. So then you will not get the return. Another one is there's a high risk involved in certain shares, and because that's the reason, because if a company is liquidated, you've bought shares, then you will risk losing your investment. You will lose your investment in that company. Okay, last one is dividends declared might be determined on external factors, and that's, for example, it's your dividends declared can be determined by the management or directors of the company. So let's say the company's board of directors decides that dividends will only be paid out on a portion of the profit, then that's the return that you will be getting. So that's the external factor that was referred to here. Okay, that concludes shares. And the last one is that we're going to look at is fixed deposits. So if you remember right, in the previous video, it's a conservative method. You cannot withdraw money or add it in this investment period, and you need to understand you can't access your money. Okay, so advantages, disadvantages. You've got a fixed interest rate, and that that means that even if there's changes in the economic climate, you will receive your interest. Okay, as the interest rate fluctuates, you've got a fixed interest rate, which means you'll get the amount that you fixed it at. Next one is the flexible investment period. So you can choose whether you want to which type of fixed deposit you want to have, a short-term, medium, or long-term investment period. So you just need to understand that in that period, whether short or medium or long-term, you cannot access your funds. Okay, your choice of investment period. So this is your choice. You can choose whatever suits you. Then the principal amount, your investment and interest. You will be recompensated. If you take out a fixed deposit at the bank will pay out your investment capital plus the interest that has accumulated up until the maturity date, your interest that was earned. Okay. Then it's a financial discipline that investors will learn, because they can't withdraw their funds. So there's a characteristic that is being grown. Another one is there's a better return on investment than your savings account, so your return is higher than just a normal savings account. And lastly, if you increase your initial or your invested amount for a longer period, so let's say it this way, the higher your invested amount over a longer investment period will lead to a higher interest rate offered, and then will also lead to a higher output or a result. When you look at the disadvantages, you can't withdraw your funds before maturity rate, so there's no access. There's a low return compared to other investments, and it may not outperform the effect of inflation over a long term. So inflation might increase, and over a long term, your returns might not be as good as you thought it was. Okay, so thank you for watching. If you've got any questions, please send them through. Please complete the activities, and these activities that you see are very similar, or it is the same as the activities of the previous video, because it's linked, it's similar type of questions, but ensure that this is done in the next period. Okay, thank you very much.